Thanks everyone for having me and giving me the opportunity to speak at this forum. I really want to talk today about why housing markets always leave some people behind, what we might do about it. But first, let me convince you that our housing debate is inaccurate, contradictory, and incomplete. I asked my Twitter followers last year, what's wrong with housing? And here are some of the things they said. There's too much density in the suburbs, not enough density in the suburbs. We must tax property more. Not enough taxes on property. Too many investor buyers. Too few investor buyers in the rental market. We need tiny homes. We need better homes. Mortgage rates are too high. Mortgage rates are too low. There are too many vacant homes. There are not enough vacant homes. You noticed, right? It's a series of contradictions. What's right about housing is what's wrong for another person. So when we talk of fixing the housing crisis, we must first be clear about what the real problem is. Let me take us back through history first to 1836. Charles Darwin arrived in Sydney on the HMS Beagle when the population was just 19,000 people. And in his first day's diary entry, before he noticed the animals, he noticed the people, and he wrote on that day, "The number of large homes recently built is truly surprising. Nevertheless, everyone complains of the high rents and difficulty in procuring a house." So our housing problems are age old, and therefore any explanation for what's wrong with them today must fit the historical data. It's far too tempting today to just blame our political opponents instead. So a common theme of this historical problem in housing was that any system of property rights, exclusive rights to land that grant some people exclusive access to space, is tightly linked to the economic cycle. And during that cycle, leaves those who don't own a share of those rights, they leave them behind. So let's dig in a little further with a thought experiment. Imagine for a moment that the same 11 million homes in Australia that exist now were all owned mortgage-free by their current occupants. Would anyone think there's a housing crisis? If you say no, then we can identify that the problem is not that there are the wrong number of homes, but that it is something to do with the way we access homes via rents and prices in the market that causes problems for some people. Let's take one more step. Is the problem of access to housing evenly distributed? Or is it the case that one person's expensive housing and rising rents is another person's growing income and asset value? I call this problem at the heart of housing, whereby the cost of buying to a buyer or a renter is the income to a landlord or a property owner, the symmetry of housing markets. This symmetry sits at the heart of all dilemmas in housing now and throughout history. Making homes cheaper to rent means making landlords poorer, dollar for dollar. This is why we can have headlines in the media on the same day calling for action on housing affordability, whatever that means these days, right next to an article about which suburbs are expected to see the fastest capital growth. In other words, which places will become unaffordable the fastest. So there are two sides to the housing market, and the press likes to entertain them both. But just because the markets contain a tricky economic and political symmetry, it doesn't mean they don't offer some good outcomes too. If we want to know what's wrong with housing, we should probably understand what's right with it. So let's talk about what housing markets do. Okay? Some people think housing markets will make homes cheap for everyone, everywhere. But they don't do that. What they do is they automatically make many necessary trade-offs across many dimensions. And any housing system, non-market public housing, social housing, has to make these trade-offs too. To see how they do this, a big concept we need is called equilibrium. It's a niche term, but it just means the net result of trade-offs and choices. I'll give you an example. We've all been to the supermarket checkouts during a busy period with long queues. What do you notice? Are the queues two people long in one checkout and 10 people long in the other? No. Because of the choice to make that trade, a market choice to trade one queue for the other, all the queues end up being roughly the same length. That's an equilibrium. That's what economists mean. And you might have even noticed it in a traffic jam, right? Both lanes of traffic jams on average go the same speed. Why is that? Because if one lane's moving faster, people can choose, they can switch, they can make a trade-off. And they can move from the slow lane to the fast lane. And that speeds up the slow lane and slows down the fast lane. And what you notice in the checkouts and the traffic is that it takes just a few traders, a few lane switches to sustain the equilibrium. And that's true in housing too. 1 in 20 dwellings are traded each year, but that sustains the market price. So let's see how this works, what trade-offs housing markets make on many different dimensions. And let's start with price. The asset price of housing emerges from the few people who trade homes each year. One's checkout queue is a housing asset. The other checkout queue is a cash asset or a share or anything else that you can trade to if you sell the home. What happens is if housing looks like a bad investment, people stop switching into housing and switching into other assets. If it looks like a good investment, they switch back. And it must be this way, right? In fact, if we look historically, the total return to housing and other assets, risk adjusted, is the same. And it must be. Otherwise, people would have switched into other assets. And in fact, this is why monetary policy works. A central bank increases the return on cash assets in one queue, so people stop switching out of cash and into housing, or in fact, switch back to get the better returns in the cash queue, slowing down those trades from cash to housing, and in the process, slowing down building housing too, because trading cash for homes can happen by buying a secondhand home or a new one. Okay. So we want housing markets to make these trade-offs. We don't want housing to be an abnormally good or bad investment. If housing makes a better return, we switch in. If it makes a worse return, switch out. That happened in Sydney in the 2010s. The first half of that decade, everyone switched into housing. More homes got built, prices went up. In the second half of the decade, people switched back. We stopped building and prices and rents both fell. We forget when they fall. What about the rental market? Equilibrium holds here too. And in fact, if we look at the survey of income and housing conducted by the ABS every few years, we can see that on average, the median is stable as well, but the average is 20% of total spending by households goes to rent. So 20% of renter households' income goes to rent. Now, that was the outcome in 2021 in the census, in 2016, in 2011, in 2001, and even way back in 1991. There is this equilibrium, an even amount across the market where households spend roughly a fixed share of their income on housing. And this is easy to sustain because one queue is spend more on housing and one queue is spend more on other goods and services. And if the price of housing comes down, what do? You spend more on housing. And you don't buy more homes per household. You buy bigger homes or better homes or have fewer people in them or some combination, all of which lets you get more housing or the attributes you value of housing and less of something else. And then if housing gets too expensive, you switch back, you consolidate the number of people per homes, you move to an inferior location, and you spend more on other things. And that's what's been happening recently. So this is something housing markets get right. We want people to be able to make trade-offs about how much they spend on rent, how many people they live with, whether they spend more on housing in a fancy suburb or less in another suburb and spend more time commuting. That trade-off needs to be made. Now, you might argue that some people don't have a choice, they have to live somewhere else. And then this brings us to another dimension where markets make trade-offs, the spatial dimension. It seems intuitive, and we call it the spatial equilibrium. But people can voluntarily switch locations, just like they can switch lanes in a traffic jam. And on average, this trading of locations equalizes the quality of life. And the premium you pay to rent in a superior location is exactly what the value of the better quality of life you think you'll get there is. So you might have a home in Bondi Beach. Moving from Bondi Beach to Ballarat, for example, might, for the same identical dwelling, might save you $60,000 in after-tax income. That's the market's estimate of the quality of life premium for moving to Bondi Beach. If that difference was less, more people would move to Bondi, making rents lower elsewhere and higher in Bondi until we return that gap. Now, a direct move from Ballarat to Bondi Beach is unlikely, but shifting one suburb over and then other people shifting one suburb over and so on and so forth still works. Just like a few people changing lanes in a traffic jam works, a few people changing one suburb over works to sustain that equilibrium. And let me make one last point about what markets do well, or the trade-offs they make. Markets trade off building more today or building more tomorrow, right? The two supermarket checkouts, building today, other ones building tomorrow. The rate at which we build is how quickly people shift from the tomorrow queue to the today queue. And we want markets to do that. If building housing is not making a good return today, we want people to switch out and build housing later. We want people to build other non-housing things today instead. And the name we have for that equilibrium outcome is called the absorption rate. It's how quickly we build homes. We get that wrong a lot when we get distracted by the supply myth in housing, that if only we did something, got rid of a regulation, this trade-off would no longer exist in the property market. Now, that's just wrong. So the problem with the housing market is not that trade-offs get made across all these dimensions. That's what's right with the housing market. And I think it's important to acknowledge 67% of households are homeowners, 18% of households are landlords, not exclusive groups, overlapping groups. And the market works really well for them. And that's the majority of people. What's wrong with the market is that these trade-offs, just because they get made, aren't necessarily fair or reasonable. And it doesn't mean that just because the market's made a trade-off that we can't do better. Okay. And it's periods of rapid economic adjustment where these negative effects are most severe. Those boom and bust cycles in property market where people get left behind. So property markets make trade-offs and they change with economic conditions. That's good. But they're not fair about it. And the faster they change, the less we like it. Let me give you some examples. Since COVID, rents have increased around 50% on the Gold Coast, right? Now, that rent was driven by the incomes of people arriving and renting homes in the Gold Coast. But of course, not everybody's income went up 50%. If you were just trying to stay put at the Gold Coast and your income stayed flat, but the rest of the market moved, you still have to compete with them just to stay where you live. So you get pushed to the sort of back of the queue, so to speak. Okay. And that's the fairness problem, right? In a boom, incomes rise unevenly. Those whose income rise faster move to better locations and outbid for rents. In a bust, incomes fall unevenly, and certain households have big income shocks and get squeezed and have to move to other locations. Okay, so the market's good at adjusting, but we wouldn't expect, right, these types of trade-offs. We don't allow them in other areas. Let's go back to the supermarket checkout. Imagine you're in the checkout queue. You've got an elderly lady at the back of the queue waiting. Now a bunch of rich, hurried shoppers arrive and they start paying the people at the front of the queue to take their place, right? What's our elderly renter retiree at the back of the queue meant to do? Right? They stay at the back. And the faster this happens, the more they get pushed to the back. Same thing with surge pricing. You know, when Uber came, people hated surge pricing. In fact, most taxi systems are regulated so they can't do surge pricing. In fact, we call it price gouging when we have these sudden effects and retailers try and put up the price of their existing inventory to make the trade-off of who gets it. Right? So there are limits to market pricing. And they are most extreme in housing when the market's changing quickly, right? How do we escape this side effect of market trade-offs? Well, the first way we do it, home ownership. You compete once, and after that, your landlord's very good to you, even if your suburb is rising in rental value. Okay, you get rent controlled by your landlord once you've bought your house. It's equivalent to owning your own car rather than getting Uber during a big event. You still get to drive it cheaply. You don't have to face that surge pricing. And we've historically encouraged home ownership because of these benefits. Australia increased its home ownership rate in the capital cities from a little over 40% prior to World War II to a little over 70% in the early 1970s. Much of this was subsidizing people into publicly funded or built housing to give them those stability benefits of home ownership. Another way to smooth out the rapid changes is with rent controls. I know those words are taboo, but they shouldn't be. And it's not clear why markets adjusting to higher inflation or higher incomes with rising rents has to happen so quickly. Why do rents need to rise 50% over 2 years and not 50% over 5 years? Why? Limiting the pace of rental increases is completely standard in much of the world. And during those long, stable periods, property is cyclical, there are stable periods, it wouldn't really have much effect. And we know stabilizing cash flows is valuable because in New South Wales and Queensland, landlords get their land tax payments stabilized. Instead of, if your land value grows 50%, paying 50% more land tax this year, we average your land value over 3 years. So that 50% increase happens incrementally over 3 years instead of 1 year. I think if it's fair for landlords, it's fair for tenants. The last way we avoid the negative outcomes of all these market trade-offs is we offer non-market options with regulated prices, either to rent or to buy, to people who don't have homes. And those regulated prices avoid that pricing competition and that bidding war. They do involve some queuing, just like the supermarket checkout instead. But having an additional option is better than not having it at all. Now, organizing any non-market housing system is still tricky, and all those trade-offs still need to be made. Who gets it? At what price? What are their obligations? How long can they have it? How do they move? And who gets it then? Markets make those trade-offs automatically, but we can have a regulated non-market system as well that has different ways to make those trade-offs in addition to the market system. There's a fairness component still to this. If someone moves into my street and gets a regulated non-market home and might be renting for $300 a week, and I've rented my place for $500 or $1,000 a week, I might feel like that's a little bit unfair. So we need to come up with allocation rules that are fair. So I support making subsidized housing as universal as possible so that we minimize these trade-offs. So people will voluntarily trade into the non-market housing from the market housing. Now, I've proposed the best way to do this, in addition to the targeted public housing for the very lowest income households, is to copy Singapore's Housing Development Board and the basic economic design. And I've called the Australian variation of that Housemate. And in short, any citizen who's above a certain age who doesn't already own residential property gets the option to buy a home at a discounted, regulated price in their city from the Development Board or from Housemate. These dwellings, like our public schools, will be dispersed around the suburbs and of a similar relative value. So in premium areas, you'll have smaller apartments at a higher regulated price. And in outer areas, you'll have larger homes, but at a lower regulated price. You get to make that location trade-off as well. And because this is, because any large non-regulated or non-market regulated system is going to be relatively attractive initially to a lot of people, we'll need some kind of trade-off rationing mechanism to who gets the initial home. So I think we'd have to start with some kind of key workers and couples getting priority. And then as the system expands, making it more universal. It's just like public schools, public roads, public parks, and hospitals. They're all universal, and we all love them. The unique part of the Singapore approach to non-market housing is that these homes are owned in a parallel market. They're not rented, you buy them. The Housing Development Board will also lend you money cheaply to buy as well. and you can resell after 5 years and buy a different one if you want to move. So it allows some of those trade-offs that happen in the market, in the parallel regulated market, and you can resell those homes to other buyers who qualify for that discounted new home. So over a decade or two, this type of program through building and buying homes across Australia's cities and suburbs could grow to around 1 million dwellings, or about 10% of the housing stock, increasing home ownership from 67% to 77%, taking private rental from 30% down to 20%, and provide a huge relief valve for those left behind during those periods of market adjustment. I think it's a very different world where your rent rises 50% in 2 years and you don't have any alternative except moving very remotely, or a world where your rent rises 50% 2 years in 2 years, but you can buy a discounted regulated home and you just got to wait another year or two for it. I think that's a very different world that people would appreciate a lot more. In fact, in wealthy cities across much of Europe, the non-market housing share, the regulated rental market, is between 15 and 30% of all housing in those cities, with various regimes, either rental, purchase, income contingent, or not homes. Now, Australia might not get that high because, remember, we have a large share of home ownership already, but I think we could expand that with non-market home ownership and shrink that pool of renters who are those households most affected by the rapid repricing and those rapid changes and trade-offs that the housing market makes. So next cycle, next boom or next bust, instead of 30% of renters competing, we've got 20%, and out of that 20%, most of them are comfortable with paying the price because they're the ones moving, whose incomes are rising and moving to new cities. I hope that stimulated some discussion and some thinking, and thanks very much for having me.